Good morning, folks. Ben Bergreen here, Senior Trading Mentor at ITPM, an ex-hedge fund manager. So what are we talking about? It really comes down to the emotional impact on trading decisions based on past market performance, where irrational human behavior gets triggered based on what's going on in the market. And then this trickles back into asset prices, causing this feedback loop mechanism which you have to be aware of. All right, so there's let's say you're long, and there's a big market sell-off like we saw in the COVID of 2020. People get scared. What do? They pull their money out of the market towards the bottom, and then they want to wait until it's kind of safe to get back in. Well, in the meantime, the market bottoms, it rallies by a pretty large portion, and it's extremely frustrating. Causes people to get mad for missing the boat, not only because they exited at the lows, okay, but because they're missing this whole rally now. So this hamster wheel just keep on turning. This happens all the time, and it will probably continue to happening as people just don't change. Now, in fact, this table here shows the past 5 weeks of mutual fund asset flows, and there's been net outflows every week this year for equity funds, in a tune of 6.7 billion for the week ending May 17th. So the market climbs this proverbial wall of worry where stock prices rises in an otherwise poor economical environment. And that happens because large traders look beyond the current situation and the economical uncertainty into the future where they are more optimistic, causing the market to rally as they are kind of scaling, working their way into larger positions. Now, every economical hiccup sorts itself out over time. Sometimes it takes longer, but these are more like speed bumps that shakes out the weak hands, but causes great opportunities really for the smart money out there. You know, at the end of the day, we all want positive returns, clearly. And right now, inflation is still higher than the rates that you get in the money market or any other kind of safe investments. So you will lose money by having it sit dormant. So where do you go to have a good shot at getting positive returns? That's right, equity markets. It's kind of the only game in town now where you have at least a good chance of having positive alpha. Now, here is the XLK tech sector ETF. It's up over 30% year to date, broken out of major resistance along the way at each level by quite a decent margin. And moves like this triggers emotional feedback responses that can really mess with your rationale. So now you're making decisions not based on fundamentals or macroeconomics. It's jaded by your emotional build, okay? So here's the SMH, even more pronounced here. SMH is a semiconductor ETF, which is up over 50% year to date. Had a massive rally last week on the back of the blowout earnings from NVIDIA. And it's true, you know, a lot of this has to do with the recent flocking into anything AI related, which is probably not gonna last. This happens where, you know, people attach themselves to some theme or narrative that is occurring, thinking that it's going to continue lasting. Well, it doesn't. Okay, these are short to medium term effects, but it does pull money into the market that starts rotating into other asset classes. Not necessarily asset classes per se, but other sectors and areas of the market. Money has to go somewhere. You know, so you're not going to take your money out of the market necessarily to put it into money market to have negative returns when you're seeing these large returns in the equity market. So this is kind of how, you know, this whole thing works. Now, this is the S&P 500 ETF, SPY. We're seeing a clear uptrend with this kind of large bullish wedge forming. Not that we are technical traders, okay, but we have to be aware of these kind of evolutions in the market and pay attention, because when the scope of the market participation increases, you get a broader rally, for example, at S&P 500, and that leads to more market buying and especially short squeezes, which can really drive things higher. And that's when this kind of green monster surfaces in people's minds. They get mad, frustrated for missing out. Now they're waiting for kind of a safe spot to get in, which typically is after there's been a massive rally. Then it's considered, in their mind, safe. And that's just how things rotate around in the market. You have the smart money taking advantage of these situations, and you have most retail traders who get kind of caught holding the bag, and they can really mess with your psyche. Now here we have the S&P futures, on a weekly graph. And the reason why I'm looking at that is because this bottom indicator is the net positioning of open interest for large speculators, which are hedge funds and CTAs primarily. And this data is from the Commitment of Traders report. And right now it's showing near short record positioning. And that is pretty extreme. And when these things happen to that level, you get these counter reactions. When there's just like a divergence like that, you get counter reactions, which typically leads to huge short covering, as all these shorts need to get covered, pouring fuel on the fire, and then you're looking at a pretty massive rally. Now, we obviously haven't seen that in the broader market yet, but that's kind of the whole point of this, to keep you guys looking out for that. So there you have it, folks. Catch you next time. Over and out.